Are you investing in target date funds because they seem like the easiest option for your retirement? If so, you're not alone. Millions of Americans have turned to target date funds, thinking they offer the perfect set it and forget it approach to investing. But here's the thing, they may not be as tailored to your personal needs as you think. In today's video, we'll explore whether target date funds are right for you, and more importantly, how they could impact your long-term financial goals. And stay tuned till the end, where we use our financial planning software to evaluate how a target date fund's characteristics can impact your long-term wealth. Let's start with the basics. What are target date funds? A target date fund is a type of mutual fund that automatically adjusts its asset allocation based on a target retirement date. Sounds simple, right? The closer you get to that date, the more conservative the fund becomes, adding more bonds over time. The idea is to reduce your investment risk as you near retirement. These funds are extremely popular because they require little maintenance. Just pick the year you plan to retire, and the fund takes care of the rest. But here's where things can get tricky. Target date funds follow a one-size-fits-all approach. They don't consider your unique risk tolerance or financial goals. Let me give you an example. Let's say you're a married couple in your 40s. You and your spouse are both contributing to a target date fund. It seemed like a good fit on the surface, but here's the problem. If one spouse is more conservative and worried about market volatility, while the other spouse is more aggressive and comfortable with risk, the target date fund does not account for these differences in preference. The target date fund treats you and your spouse the same. Now, let's talk taxes. Did you know that holding target date funds in a taxable account could actually increase your tax bill? Due to the rebalancing of these target date funds to make them more conservative, they may distribute capital gains without you even realizing it. You may have heard about the lawsuit filed against Vanguard over its target date funds. The lawsuit alleges that investors faced significant tax liabilities from unexpected capital gains distributions in their taxable accounts. Imagine thinking you're doing everything right, only to find out you owe taxes on gains you didn't even realize were being distributed. This case is a perfect example of how target date funds, while convenient, may not always be the best option for everyone, especially if you're holding them in taxable accounts. So, if you're holding these funds in a taxable account, you could be better off with a more tax-efficient strategy, such as using a blend of ETFs or index funds, which can allow for more control over when you realize capital gains. So, what are your alternatives? Instead of relying on a one-size-fits-all solution like target date funds, you could create a custom portfolio tailored to your unique risk tolerance and financial goals. Consider a mix of index funds or ETFs that track the major indices. This gives you more control over your investments and can help you avoid unwanted surprises like tax liabilities or risk misalignment. Now let's talk about performance. One of the key features of these funds is that they automatically become more conservative as you approach retirement. Sounds great in theory, right? But here's the catch. As the fund shifts away from stocks and into bonds, especially after you retire, your overall returns might be lower than if you maintained a higher allocation to stocks. For example, if you enter retirement and still have a long time horizon, say 20 or 30 years, you may want more exposure to stocks to take advantage of market growth. But in a target date fund, your allocation to stocks will decrease significantly, potentially limiting your returns and leaving you with less than expected later in life. The key point here is that target date funds are designed to reduce risk, but that comes at the cost of potential performance. Let's take a look at an example to illustrate. My hypothetical 40-year-old couple is considering 3 different strategies for how they could allocate their investments throughout retirement. In the first scenario, they decide to keep things steady, maintaining a 90% allocation to stocks and 10% to bonds all the way through retirement. In the second scenario, they take a more traditional approach, gradually reducing their stock exposure as they get closer to retirement. By the time they retire, they have a much larger portion in bonds for stability, but with less potential for growth. Finally, in the third scenario, they use what's known as a SMILE strategy. This strategy starts with a high allocation to stocks, just like the first couple. But as they approach retirement, they reduce their stock exposure to minimize risk. Once they retire and their spending needs decrease, they begin to gradually increase their stock allocation again. In the first scenario, where the couple maintains a 90% stock and 10% bond allocation throughout their lives, they have a 96% probability of success. By the time they retire, it's estimated they will have close to $11 million, and their median net worth at the end of their lives is projected to be around $16.5 million. In the second scenario, where they gradually reduce their stock exposure over time, starting at 90-10 and shifting to 60-40 at retirement, then eventually reaching 30% stocks and 70% bonds in their 80s, the probability of success increases to 98%. This is primarily due to the reduced volatility as they age. However, the median ending assets are slightly lower, around $12.4 million, and they are still expected to have about $11 million at retirement. Lastly, in the third scenario, where they employ the SMILE strategy, they reduce their stock allocation to 60-40 as they approach retirement, but then gradually increase it to 80-20 later in life. This gives them a 96% probability of success. Their estimated net worth at retirement is a little over $11 million, and by the end of their lives, the median wealth is projected to be around $16.5 million. Now keep in mind, this is just a simulation. For this hypothetical couple, the differences between these strategies may not drastically change their financial future. But for you, in the real world, the choice of whether or not to use target date funds could have a significant impact on your long-term success. So, in conclusion, target date funds offer simplicity, but they lack personalization. They could be too aggressive or too conservative for your unique situation, and holding them in a taxable account could increase your tax liability. And while they may seem like a set-it-and-forget-it solution, sometimes a more tailored approach is necessary to align with your financial goals. If you're unsure whether target date funds are right for you, or if you want to explore other investment strategies, it might be time to take a closer look at your portfolio. Visit thehourlyadvisor.com to schedule a free consultation today. We'll work together to craft a financial plan tailored just for you.